that's one of those traps
Yeah.
that you mentioned before. If you don't do that, you can definitely end up with a nasty stamp duty sting.
Hi everyone, welcome to our latest edition from Catapult Wealth. My name is Tony Catt. I'm here today with Andrew Mattner, Director of Altitude Advisory. And in line with some requests we've had from a lot of our clients around succession planning and asset transfers, we get a lot of questions about moving farming land. And a lot of clients of mine have probably heard me talk about the various stages that we go through in terms of planning for these things, in terms of where the asset ownership comes in. And I've often looked at it that it's somewhere that some people try and talk about asset ownership transfer very early on in the piece. And I think that normally it's probably one of the last things we need to worry about. But it needs a lot of thought and attention, and hence why I'm sitting here talking to Andrew today. Andrew, welcome. Thanks for coming in today. I really want to get to perhaps if you've got any particular comments just from a legal point of view and probably from a tax point of view, are there capital gains tax implications of family members moving or parents moving farming land to the next generation?
Yeah, cool. Thanks, Tony. Look, this is an issue we come up across all the time in terms of succession planning with, I guess all businesses, all families, and it's something that's very relevant in farming families. And one of the things that people often forget is that capital gains tax applies where there is basically a beneficial transfer of ownership from one entity or one party to another, whether that be a family member, whether it be an unrelated third party, within potentially their own structures. So from one trust to a different trust or things like that. So where there's a change of ownership, that generally triggers what we call a CGT event. Now, before we get into some of the technical aspects of that, I think the thing to understand is capital gains tax only applies to assets that are acquired post 19th of September 1985. So anything that you've had ownership of before that basically falls out of that regime. But in general terms, if you transfer an asset, that was acquired after that date, and that could be, acquired via a direct purchase, or you may have actually acquired it via a previous succession plan from, grandparents or someone else somewhere down the track. If that asset's been acquired post, 20th September 85, then capital gains tax will apply. Whether there's actually any tax payable on that transaction or not is a different matter, but the capital gains tax regime is definitely in play. So when we then look at those things, we've actually got to go away and work out, well, if CGT does apply, what's the actual impact or the taxing result of that? And I guess the actual tax amount is the applicable tax rate for the taxpayer, whether it be an individual or a company or a super fund or whatever it might be, applied by the taxable profit. Now, the tricky bit in all this is determining what is that taxable profit amount. And this is where we look at capital gains tax discounts that are applicable to individuals, trusts, super funds, not applicable to companies. And you've got the added benefit then of small business CGT concessions that for certain qualifying businesses, if their turnover is less than $2 million, if their net assets, their applicable CGT net assets are less than $6 million, there's potentially other concessions that are available as well.
Just while we're on that topic then, in terms, so you're saying that if a client was moving a farm over or a parcel of land where there was change of ownership, it was a CGT asset, if their turnover was less than $2 million in that financial year and their assets in the year that you move it?
The year before, so there's certain test periods around that.
Yep.
So basically it's the current year or the year immediately before.
Okay.
Is that $2 million asset test, so net turnover test.
Yep.
And one of the things that we've actually found over the last a couple of years. We've had a number of clients that have been impacted with drought on the West Coast, Eyre Peninsula of South Australia particularly, and they've been in the process of going through, I guess, a family farm transition, and we've been able to take advantage of some of those capital gains tax concessions as a result of them, I guess, effectively falling into that small business criteria.
With the $6 million rule, then is that do you have to pass? Can you just pass one of the tests? You don't have to pass both.
Yeah, it's an either or.
Yeah, and the $6 million. Can you give us an idea of what would be included in $6 million worth of assets?
Yeah, so obviously farmland, livestock, money in the bank, all those sort of things, plant and equipment, all those things come into play. Debt comes off of that.
Yep.
Superannuation and private assets fall outside of that.
Yeah, okay.
So basically it's, things that fall into that broader business bucket or investment bucket is what I would say generally falls into there. You need to be very careful. It's obviously quite a complex area when you're doing the review of that to make sure that you meet either one of those criteria and those tests. But if you do, the advantages can be significant, not just for the person who's transferring the asset, but also the opportunities for the next generation to get that right, because you can potentially access some of these capital gains tax concessions, whether they be retirement exemptions, 15-year, which basically fully wipes out any capital gain. And then what the next generation basically get to do is they get to reset the cost base of the asset at today's current market value. So you can imagine, and you would have seen, like I have, significant movement in land values over the years. We've had some that we've done recently where the original acquisition of the farm might have been 20 years ago or 25 years ago at $1,000 an acre. $100 an acre.
Yeah,
that's now worth $1,000 an acre. So the actual future tax benefits attached to getting this right are significant.
One of the things that we do come across, and this topic often comes up, where parents have been approaching retirement. They start to talk not only just from a asset ownership point of view, from giving the next gen, I'll call it, some control over the assets, but also they're looking at the 5-year rules around Centrelink exemptions and asset test exemptions as well. Do you have any advice around situations where are there landmines that people need to avoid or think about when they're going through this sort of situation where they're transferring it?
Yeah, look, Centrelink's obviously one. One of my objectives is to get coach or help clients get to the point where they don't need Centrelink.
Yeah, that's right.
Down the track. But aside from that, obviously future trap is in relation to that future taxing point. So that's one where, I'll give you an example. Quite a common structure is for land to be held in a trust structure. Mum and dad might be the trustees or appointers, or they effectively control that trust. And what they do as part of their transition planning is they might just transfer control to the next generation. Now, there's not technically a change of ownership or anything like, so it doesn't trigger any CGT or any of those issues. But then what it does, it just means that asset retains that, previous cost base and things like that. So it might actually, I suppose, kicks the taxation can forward to the next generation. So that's a bit of a sleeper that people should be aware of. One of the big traps that we see is where there has been a prior succession, prior transfer, so from a generation prior, where mum and dad might have either via will or another point transferred land in the late 80s or early 90s, and I guess I'm not sure whether forgetting is the right word, but not understanding that resets the CGT date at that point in time for the new owner. The other thing is, I'll call it the trap, is the lack of, where there's not great communication between the generations about what's going on and understanding the objectives and things like that. So, the current generation that want to get out might have a view as to what they think their ideal world looks like. And they say, we're going to go and do this, we're going to do this, and we're going to do this. And they go and they come up with a fancy plan with an accountant or a lawyer or whatever. And then they go in and say, here you go, we're going to do this transition, and son, daughter, 2 sons, 2 daughters, whatever it is, with their next generation go, well, hang on, that doesn't work for us. And so having clear and open dialogue and communication around those things is critical. The more you can talk about these things and work things out, the more chance you've got of getting a good outcome, not just for the people that want to get out, but for the people that are coming in.
So, it is crucial, because you can just be creating a bigger mess for down the road for the next generation. And,
Correct.
And there's various issues there with on-farm and off-farm children. Are there any specific exemptions or related to stamp duty that relate just to farming clients? Are they given any concessions in the Australian tax environment?
Yeah, so, stamp duty is probably the obvious one. Stamp duty is a state-based tax. It applies in all the states of Australia. And I think there's lots of debates around the merit of stamp duty. I'm not going to express whether I think it's a good idea or a bad idea, but it's here and we need to deal with it. The reality is that stamp duty will apply on any conveyance, and there's then certain exemptions that are applied to either remove the stamp duty or create the taxable value at a zero level. Now, in South Australia, where there's a transfer between generations within the family, and there's a pre-existing business relationship, there is a stamp duty exemption that is in place to basically wipe out that stamp duty. There is similar exemptions in Victoria, New South Wales, Queensland, other states as well.
Yeah, there
is a few little tricks in relation to that. Especially we mentioned about the common structure about trusts or land trust holding, that you need to be very careful about your classes of beneficiaries. It's just not automatic to say, if I transfer it from this trust to that trust, that you're actually going to get that exemption.
Yep.
And therefore it's critical that you either get accounting advice to review the trust deed, and particularly legal advice around making sure the classes of beneficiary are such that you'll meet the conditions to get that exemption. Otherwise, that's one of those traps that you mentioned before. If you don't do that, you can definitely end up with a nasty stamp duty sting.
Stamp duty it can be tens of thousands of dollars, couldn't it? It could be a big number.
Yeah, correct. So, for property value at $500,000, the stamp duty is $20,000 plus, $5.50 for every $100 of excess over that. So, if you're looking at $1 million transfer, you're talking about, $40,000 to $50,000 in stamp duty.
Could be a big problem.
Can be a big problem.
And that particularly, I assume that issue would come up where clients either assume otherwise that they can leave potential farming assets to off-farm children if there's no connection, or they're not beneficiaries of trusts and things like that.
Correct. So that's that business relationship that exists. So, it's critical that, that nexus is there, and there's declarations that need to be done at the time of transfer, establishing that business relationship. And whoever's doing the transfer will need to present certain documents of proof to the State Revenue Office to support that.
One of the questions that springs to mind as well with transfer is that we often see a lot of farmers structured with a land trust, and then they've got an operating trust or a partnership of some description. And one of there's still major assets such as cattle, sheep, machinery that sit in the operating trust. I assume there's lots of do's and don'ts around the non-land assets as well, to a degree too, that people would trip up on all the time. Depreciation, written down values, etc.
Yeah. Look, it depends. Probably the operating assets, Tony, are the easiest ones to deal with when they're in a trust structure from a transfer perspective. And the reason for that is, as part of a generational transfer, whether it be while you're alive or when you die, in a trust, you're actually dealing with control of the assets, not the actual necessarily the ownership of the assets. So from an operating perspective, basically, once you change control of that from one generation to the next, basically, they just pick up and they just step straight into your shoes and continue to operate things. Aside from some administrative changes like banks and other bits and pieces, generally that is relatively straightforward. The harder bit is when we're dealing with the CGT assets like land and things like that, where there's an actual change of ownership that needs to come into play.
One of the issues, though, would be a partnership, I would assume.
Partnerships do create issues because, there is, again, you need, there's certain mechanisms within the taxation legislation to basically manage those taxation events to ensure that you don't, crystallise profits on market value of livestock or plant and equipment or whatever it might be. But there is the right way and the wrong way to do it. You just can't, literally go down and draw a new partnership agreement between, mum, dad and son or daughter and say, well, we've got this covered. There's elections that need to be signed. There is compliance stuff that needs to go around that to make sure it happens effectively.
Yeah, no, it's good to know. You mentioned the word banks before. Do the banks come into any form of consideration in farmland transfers or anything like that? Do they need to be kept in the loop, or
they can, especially where there's debt that we need to worry about from a security perspective. But one of the things that's really important, I think, it's like any relationship that you have when you're in business, that you've got relationships with accountants, with agronomists, with grain marketers, with insurance brokers, all those sort of things, and the bank is another relationship that need to be managed, and people need to understand that just because XYZ Bank has supported mum and dad for 20 years and it's always been okay, doesn't necessarily mean they're going to support the next generation. There might be issues or red flags or other things that come to bear, and so therefore having, again, these open and transparent conversations and keeping your advisors and your banks and all that sort of stuff in the loop as to what's going on, what the intent is, means you can just stay ahead of any of those problems that might otherwise jump out and surprise you.
Yeah, no, it is. It's about staying ahead of the game, isn't it? One of the questions we're getting asked a lot lately has been the state government has changed a lot of land tax rules lately, and there's been conjecture because everyone's getting these stamp duty notices in the post and
land tax notices.
Sorry, and is there any thing that the farming community need to worry about with owning significant millions of dollars worth of farming land that either might be leased out or used in different structures in the farming community?
No, so look, primary production land in general terms is not subject to land tax. The only rider I put on that, and that can be leased or it can be owned and leased to a third party, leased to the next generation. One of the common things is where again, one generation might keep hold of a certain parcel of land and lease it to the next generation to provide them with an income stream in their retirement. That's relatively common. But in general terms, primary production land's not subject to land tax. Now, the only exceptions to that is when it's classified as what we will otherwise call metropolitan primary production land. So there is certain geographical areas in South Australia that are dealt with. And I'm pretty sure the boundaries, around Adelaide, for example, run from, Gawler up into the Adelaide Hills down to Wollonga. So, when you're thinking if you've got, vineyards at McLaren Vale or Sellex or somewhere down there, or, you've got a grazing property or things like that up in the, or a orchard or something like that up in the Adelaide Hills, you potentially got land tax issues where you're leasing out or other bits and pieces. And the other area is down around Mount Gambier. Okay. So down in the southeast. So, but generally, if you're outside those two boundaries, land tax is you're okay.
Yeah. Which is good to know. One of the other issues that comes up with succession planning and moving farming assets from one generation to another, or even to off-farm children, a lot of farmers now have been putting land in super funds, and a lot of conjecture around how to get the land out of the super fund should they want to either do it pre-death or at death. Have you got any comments, or is there anything to watch out for there?
Look, super funds create a slightly different dynamic with it, and putting farmland in superannuation from a taxation perspective, from a future retirement income perspective, it all makes a lot of sense. And in terms of a strategy, that's something that they'll obviously speak to you about, because this becomes an investment decision as much as anything. But in saying that, when getting it out, getting it out on the death of the final party or before, that's where that can potentially be a little bit challenging. You won't necessarily get the same stamp duty exemptions and things like that you would otherwise have in play. But I suppose the thing with that is capital gains tax within a superannuation environment becomes somewhat less of an issue. And that's because, I guess, obviously depending on the asset base and things like that in the super fund, generally what happens if you're in pension mode within a super fund, capital gains are effectively tax-free and zero. But obviously subject to your $1.6 million caps each and things like that. So
stamp duty might be the only thing to watch out for.
Stamp duty, probably in that case, the only thing that we need to be aware of.
Yeah. Do you have any, I call it, structures, or is there any preference of the types of setups that you do see moving to a next generation? That a lot of people, some people talk about companies incessantly using them. Some people swear by partnerships. Some people swear by trusts. Do you have any particular comment around different structures that you see that work?
Look, really, Tony, what I would say with that, it's horses for courses. Every family business has different dynamics. Has got different needs, both on farm, off farm, lifestyle. Number of children. There's a whole lot of factors that come into play. And then you start looking at what I'll call the passive assets, like land versus active assets and things like that, because you need to factor in various considerations. So access to capital, funding arrangements,
borrowing,
succession arrangements, taxation arrangements. The flexibility of things around farm management deposits. So if you're in I'll call it a highly profitable area where you make profits year on year on year, and it's just a question of how much those profits are, then a trust structure for operations generally works okay from a farm management deposit perspective. But then if you're in highly variable regions where you might go from a big profit to a big loss in a 12-month or 2-year time frame, getting farm management deposits back out after you put them in doesn't necessarily help.
Offset the loss.
Doesn't offset the loss. Yeah. So you need to be careful around some of those things. And what we do when we're going through these discussions with clients, we say, okay, well, look, what are all the important factors here? And then we go, well, which ones of these can we achieve in which structure, and then work through to pick the best one. But sometimes it's a little bit of, you can't have everything.
No, that's right.
And you might have to pick that and that and that and have to give up that.
Yeah. So. And that would probably raise 2 points then in terms of people needing to, I assume there's probably, generational farmers that are potentially in their 40s or 50s that might look to get ahead of the game, if you know what I mean, in terms of restructuring their assets ready for a transition. And I assume that you would recommend that they look at their situation critically, see if there's a restructure that needs to be done in lieu of their circumstances. And secondly, the second thing that springs to mind is that if you've got a 20 to 30-year-old or 35-year-old son or daughter coming back onto the farm, for them to get advice to know what they're transferring it into, there'd be clearly two different types of clients there.
Correct. And look, I think more and more we're seeing, farm owners or primary production operators think of their farm as a business, not as a farm.
No, yeah.
So they are running a business. They just happen to be farming. And that creates a different thought process where things like, strategic allocation of assets becomes part of an annual review. So you're doing an annual planning session or whatever it might be with the client and say, okay, this is our strategic direction. This is where we're going. This is our next 3-year plan. Is what we've got now, is it going to get us to our 3-year plan? Or if it's not going to get us to our 3-year plan, how do we change it, or a 10-year plan, or whatever it may be? But there's a lot more conversations happening around that strategic thought, which takes into account the ownership of those assets. Now, similarly then with the next generation coming back in, getting an understanding of what they're getting into is critical. And lots of ideas, lots of enthusiasm and all that sort of stuff, but understanding then the basic fundamentals around all these things and understanding how structures work, what the taxation impacts, finance impacts, all these things are critical. No longer, I don't think it ever was, is it a reasonable excuse to say, well, I don't understand?
No, that's right.
I think it's incumbent on everybody that's involved in business to understand what they're getting themselves into. And I think generally, Tony, advisors, or what I'll say is modern day advisors, are doing this better than they've done it ever before. They're encouraging a lot more conversations. I still think there's a lot of advisors, whether they be accountants or lawyers out there, that do a really poor job of this. And they sit down with mum and dad and say, we draw up this magic plan that I spoke about earlier, and that either works or it doesn't work. And a lot of times you see them stuck in the top drawer because it creates conflict. It doesn't ever go anywhere. There could be issues with in-laws or outlaws, depending on what you want to, how you want to refer to them as. And by not having the understanding or conversations and doing this in a collaborative way, then that can create all sorts of issues. And I think, bringing it to the table and having open and honest dialogue about it is the best way to navigate through it.
So it's interesting you say that. So the kids, sometimes you find that they just assume that mum and dad, they should just do it the same way that mum and dad did it. We'll just use a trust or a partnership because that's what mum and dad did. But what I'm hearing is that you've really got to assess it on your own merits, and what got you there won't get you here. And
yeah, correct.
Yeah,
there could be a whole lot of different dynamics, and the reality is that whether you be 20 or 30 or 40 or whatever it is, you think of things and look at things through a different lens than what the your prior generations looked at it through, and there's nothing wrong with that. It just is. It's just different, and so therefore it's really important not to assume that what worked 30 years ago is going to work next week. Absolutely,
and also obviously with different seasonal changes, the technology changes in terms of where people are making money these days. It does change quite dramatically.
Yeah.
Andrew, thank you very much for coming in, mate. It's obviously one of the things that I've heard today is that communication, planning, staying ahead of the game, and collaborating with your different advisors and the banks and so on and your family is really crucial, which is something that I absolutely condone for all the families listening out there. So thanks for coming in, mate. I really appreciate it, and look forward to chatting again.
Pleasure.